gold denominated or Bitcoin denominated debt on their balance sheet for 30 years. It wouldn't make, governments wouldn't be able to have these kind of like 30-year bonds that they just keep rolling over and just kind of ever growing debt to GDP ratios. It wouldn't make sense to have a house that you buy on a 30-year mortgage denominated in things like gold or Bitcoin.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about Bitcoin. Lyn Alden says, Bitcoin named obligation on their asset report for a long time. It wouldn't make you realize states wouldn't have the option to have these similar to 30-year bonds that they simply keep turning over and only sort of truly developing obligation to gross domestic product proportions. It wouldn't seem okay to have a house that you purchase in a 30-year contract, named things like gold or Bitcoin on the off chance that you check the typical, as out we should say the middle home. You realize it by and large doesn't beat gold, particularly when you think about support furthermore. Duties, and that's what things like thus you wouldn't short gold and use it to purchase a house. You just short of a cash to purchase a house thus. In that kind of hard cash climate, the sorts of obligation that would in any case exist, I think would be profoundly useful, more limited term obligation, and lots of things Lyn Alden discuss, so please watch the video to end, and like, share, subscribe our channel Everyday Finance, thanks.
Yeah, I think that the overall credit would be vastly reduced in that type of system. I don't think it'd be zero credit, but I think it would be much reduced credit. And again, you can kind of separate into two types, which is things like debt as a permanent part of a capital structure or long duration debt would make a lot less sense. So for example, it wouldn't make any sense for Coca-Cola to have gold denominated or Bitcoin denominated debt on their balance sheet for 30 years. It wouldn't make, governments wouldn't be able to have these kind of like 30-year bonds that they just keep rolling over and just kind of ever growing debt to GDP ratios. It wouldn't make sense to have a house that you buy on a 30-year mortgage denominated in things like gold or Bitcoin. If you look at the average, like let's say the median home, it generally does not outperform gold, especially when you consider maintenance and taxes and things like that. And so you wouldn't short gold and use it to buy a house. You'd only short fiat currency to buy a house. And so in that type of hard money environment, the types of debt that would still exist, I think, would be highly productive shorter term debt. It could be, for example, you're a business and you want to have like a revolving credit line for seasonal changes in your business. That kind of thing is collateralized by the equity of your business. Maybe if you're a homeowner, you want to get a very small loan to do an expansion of some sort. There could be a liquidity provision collateralizing your home with a very low loan to value ratio. If someone wants to get education, I mean, there's multiple ways to do it, but one of the ways could still be, taking on small amounts of credit if you're doing something that's going to probably increase your income substantially. You could have a business expansion where you don't really want to give away your equity permanently, so you're able to secure a little kind of maybe a 2-year loan that's again collateralized by your business for that expansion. Maybe you're buying a home and you get like a 5-year payment term. That's common in Egypt. I was just in Egypt. They will generally buy homes with like 3-year, 5-year, 7-year installment plans rather than like this 30-year, because no one's going to lend for super long terms in the Egyptian pound for opposite reasons. And so I think there is still credit provision that makes sense in that world, but it's just much smaller because most of those kind of long duration permanent rolling debt balances no longer make sense, and only high impactful, high rate of return, very safe types of debt are what makes sense. And then they wouldn't be fractionally reserved, or at least it wouldn't make sense safely to fractionally reserve them. That would be backed up by capital that is duration matched, or that is kind of permanent capital of a lending institution. Yeah, debt in the fiat standard is a core part of the system because most fiat currency comes into existence through debt creation. And the incentives to have some degree of debt are very high in the fiat currency system. And people that avoid having debt for moral reasons or other reasons end up getting kind of punished for having that view, even though historically that view was often rewarded. Basically, in this environment, savings kind of de-emphasized and having moderate amounts of debt is emphasized because that's what works well over time. Whereas if you had Bitcoin as the base layer of money, that goes back to rewarding savers You don't have to lend it out to maintain your stack. That's just like an optional thing that professionals could choose to engage in. And the borrowers will not get rewarded unless they're doing something very high impactful, basically engaging in some degree of entrepreneurship or something like that, rather than just making use of the fact that they're able to short something that depreciates over time. Sure, and this was a concept that was originally popularized by Wences Casares many years ago, but it's not really something that appears much in literature. And so I really like that framing. There have been a number of people that have kind of maintained that idea since. He doesn't really do a lot of content anymore, but there are other people that kind of make that reference. And I eventually came across that reference, not from him directly, but just from others talking about it. And I took that pretty literally, and I felt that was probably the best way to describe money. And it's also a unifying tool between different views of money, and it kind of reconciles kind of the two initial ways that money emerged. And so when we think of what money is, most definitions I think capture like 80% of it, but then there's like a little bit they don't capture. And so different definitions kind of capture most of it. But I think that one might be the most complete because on one hand, humans control their own little ledgers, right? So if you're trying to solve the double quintessence of wants, right, you're trying to trade, there's really two main ways to do it. One is that you can defer it over time so that you make the coincidence easier to solve by the fact that you don't have to have a surplus of what the other person needs right now. You can just exchange a value for something and then that person owes you at a later time. So that's been around since, hunter-gatherer times, partially as gift culture, partially as kind of just local kin and family and neighbor types of arrangements. And of course, the other way to do it is with a highly saleable commodity that acts as a unit of account and basically the most tradable good that can be on one side of every transaction. And that'd be the commodity theory of money. And one way of kind of reconciling those as a broader concept is that they're both types of ledgers. One of them is a human-controlled ledger, either in a small community or with an administrative state of some sort, like the temples of Babylon. Of course, the modern day equivalent would be central banking, or you let nature be the maintainer of the ledger in the sense that whether it's hunter-gatherers with, say, shell beads or it's gold coins and bars, nature sets the parameters for how much of this unit can exist, how hard it is to create, how to create it, and people kind of defer to that natural scarcity as their ledger. And they don't necessarily see the whole ledger, but by physical exchange, by physical possession, they update the ledger. And so each one can kind of assess the properties of the ledger without necessarily seeing the full picture, just by looking around and seeing how rare is it, how hard is it to make, how often do I see it with other people. They can come to assessment of that commodity as a useful type of money. And then of course Bitcoin is interesting because in many ways it reconciles these views together in the most perfected form we've seen, which is you have a literal ledger that you can fully audit and it's fully transparent, but at the same time, instead of being like a centralized ledger run by a community or a temple or a central bank, it's a decentralized ledger that does have scarcity associated with it. So I just generally found that to be a interesting way to think about money, and it can potentially reach to different schools of thought and kind of bring them together to some extent. Yeah, that's something that was explored back in the Bitcoin standard and other works, basically that as technology improved over time, we were good at kind of eliminating certain types of commodity monies that were previously useful. So in a pre-industrialized society, seashells and other bead-like instruments were very useful money. But once we had the Industrial Revolution and that type of technological ability, and even somewhat before that in many cultures, that really kind of ruled out that type of money as being supply constrained in any sort of realistic way. And so we kind of went up the hierarchy of different types of commodity hardness until we got to silver and gold. And those are the ones that are still, especially gold, still relevant for today. Central banks still hold significant amounts of gold usually. And what I found interesting is that progression of technology that affects what commodity monies are useful also plays a role in kind of the rise of the credit theory of money. And I would put chartalism kind of in that camp. It's kind of like, within the credit theory of money, you have a couple different camps. You have kind of the more emergent credit money, like a small community running its own ledger. And then you have like kind of the the bigger nation state type of ledger system. But they're both basically types of credit theory. And what's interesting about those is that although credit itself extends back to hunter-gatherer times, these more explicit monetary theories based around credit mostly arose with the invention of the telegraph. So, for commodity money theory stretches back, it's millennia, and that's been around for a long period of time. Whereas the credit theory, once they invented and specifically once they deployed and made common use of the telegraph, when you could send information around very quickly, and gold had to be abstracted heavily to keep up with this arrangement, people kind of started naturally thinking, what is money anyway? Or why do we need to tether it to gold? And you can see why intelligent people at the time would start asking these questions. And you mentioned David Graeber. I cite his work, but I mean, he for example heavily cites Alfred Michelin's in his work, and I think that's kind of the, if you're looking for some of the strongest source material in that camp, you'd probably go back to his essays. It's also way shorter to read. It's, you can read his two major essays from like the early 1900s, over a century ago. They kind of lay out his case. He's clearly an intelligent person. But there's others at the time too, including the development of chartalism, where they were kind of making the case that commodities are not money. That's kind of arbitrary. And of course, I disagree with that view in many ways, and I go over the disagreements in my book. But it's really the rise of the telegraph and this kind of information-based transaction system that even gave them an opening to make this type of argument and to sound somewhat sophisticated in what they're saying. Whereas pre-telegraph, it'd be very hard to make that argument. And one of the big themes in the book is that that kind of century and a half where we had the speed of transactions at roughly the speed of light, but the speed of physical settlement of things like gold or other scarce money still at the speed of matter, created basically a huge arbitrage for banks, central banks. It required abstraction and credit in order to kind of bridge the gap between that transaction speed and that settlement speed, and eventually it kind of completely broke that tether. And so we find ourselves in a world where there's 160 different fiat currencies. Each person is kind of just finds themselves in a bubble, and they hope that they're born in one of the areas that's more developed and has a stronger currency system compared to the long tail where most of us end up in weaker currencies, where it's very hard to build liquid capital. And the kind of the theme of technological determinism is at play in the sense that we don't see one country with a gold standard today. We don't see one country with full reserve banking today. The technology kind of enables or empowers certain incentive structures that just kind of become ubiquitous. And of course, what's notable about Bitcoin is that it's the first credible way to have settlements that are as fast as transactions, which is that the ledger itself can be updated in a similar way that, back in the shell era or the gold era, by physical possession, you'd update the ledger, less credit needed. But now you basically have that in digital form where you can, agree over the internet and things like that to do a transaction. And the settlement itself can happen either in real time or in near real time with that type of transaction. And so that potentially collapses the need for abstraction, centralization, credit, at least certain types of credit for that whole arrangement. So that's one of the reasons why I find that framing to be useful, because for a century and a half, there really wasn't better technology, and finally there is. And another point is that order had to happen that way. Like, there's no world where Bitcoin's invented and then the telegraph's invented, right? It's like telegraph is invented, transactions only need a minimal amount of data, and then over time, as we have the internet, as we have bandwidth, as we have radio, as we have more complex mathematical proofs, as we have encryption, eventually you can get something as complex as Bitcoin that allows for that digital settlement. And so I just think that's another thing that maybe is not as covered as it could be in a number of Bitcoin books.